Well, good morning and welcome back to the Broadcast Retirement Network. I'm Jeff Snyder, and this is BRN Sunday. So glad you could join us this week. I'm going to be joined by members of the media, academia, and financial services as we look around the globe and analyze all the news in retirement markets, technology, personal finance, so much more. We've got another great show for you this week, and our contributors are really digging down and ramping up. So sit back and relax for this episode of BRN Sunday. We're going to kick things off with a look at personal finance. Joining me on the line, she is personal finance reporter for The Motley Fool, Miss Mari Backman. Hi, Mari. Welcome back to the program. Great to talk to you again today.
Thanks, Jeff. How you doing?
I'm doing okay. A little bit of a brain freeze at the top of the show, but hey, that happens. But I know you wanted to talk about cola, and I'm assuming you don't want to talk about Coca-Cola.
No, not the soft drink. We're going to talk about cost of living adjustments. Those are the annual raises that Social Security beneficiaries are entitled to year after year. Basically, every year in October is when the COLA or raise gets announced for the upcoming year. The reason being that these raises are actually calculated based on consumer spending data from the third quarter. So basically, they need to compile that data from July, August, and September. Once we get that information in October, the Social Security Administration can announce what the COLA is going to be for the upcoming year. So without further ado, 2021's COLA or raise is going to be, as of now, 1.3% for seniors.
Wow. That's not very good.
No, let's talk about whether that's good or bad. Number one, it's not great. 1.3%. Most people, right? You get like a cost of living raise at work, and that's between 2.5 and 3% usually. Historic inflation, that's more aligned with that. But 1.3%, it's low. Now, earlier in the year, it seemed like there would actually be no Social Security COLA at all. Mm-hmm. Reason being that, when consumer spending basically just fell off a cliff, when everything on the coronavirus front exploded, gas prices went down. So, basically when the cost of common consumer goods goes down, that impacts COLAs. That basically makes it so that you're less likely to get a COLA. But when basically it's all dependent on the consumer price index. When the consumer price index shows an increase or an uptick in pricing, that's when you are in line for a COLA. So earlier in the year, there were all these reports, and I even wrote one myself saying seniors may not get a COLA at all going into 2021. It's going to be terrible. So 1.3% is definitely better than zero, but it's not great.
Well, I think you bring up a really good point. And while you were chatting, and I was listening intently, Mari, so I was not listening, but I went to go look at some of the. Since you're educating your kids at home, we talked about it in a previous episode. I feel like you're my teacher in a way. I feel like I had to look at the U.S. inflation rates, and so what I looked at, this is on the U.S. inflation calculator.com. So I don't know anything about the people who put this together, but I'm assuming they take BLS numbers as they're published. So the September inflation rate was 1.4%. At the beginning of January, it was 2.5%. So it's slowly, significantly come down. But right now, that cost of living adjustment doesn't even beat out the rate of inflation as of September. So
and there's two additional problems.
Okay, go ahead.
As well. So problem number one is that the consumer price index doesn't necessarily reflect the costs that are most burdensome to seniors. For example, seniors may not be spending that much on, gas to fuel their cars because they're not working. They're not commuting daily like, their younger counterparts are. Rather, they're spending a lot of their money on health care, and the health care rate of inflation has well outpaced the general rate of inflation, especially in recent years. So the problem is that they're calculating these COLAs for seniors based on a formula that doesn't even accurately reflect their main spending pain points, right? So there's that disconnect right there. The other part of the issue is that Medicare Part B premiums tend to rise from year to year, and we don't know to what extent they're going up in 2021. But basically, this 1.3% COLA is going to translate into roughly an extra $20 a month for the average Social Security beneficiary. But seniors are not necessarily going to get that $20 a month, because if the cost of Medicare Part B increases, let's say $10 a month, that's going to come right out of that.
Yep.
And so basically, seniors are going to be looking at a net raise of like $10, which, I mean, sure, again, we can take the attitude that that's better than nothing, but the reality is it's just not a very substantial boost from year to year.
Well, a couple things that while you're talking about this and educating myself about this. Number one, I think needs to be a rethinking. I'm just going to give my personal opinion, a rethinking of this calculation process, because clearly healthcare expenses go through the roof when you hit retirement. That's number one. Number two,
Right.
You need to have a secondary means of savings. All Americans need to have a secondary means of savings. And I know that sounds like pie in the sky, and there's a lot of issues with that. But whether it's a 401k, an IRA, or just a bank account for these difficult times, that's important. And number three, if this isn't a conversation just for mature people, Mari. This is a conversation for younger people to hear as well, because you may or may not think that this benefit's going to be around, but I think it just puts more responsibility on all of us as individuals to save as much as we can through our working years, so that we're not in a situation where we're relying on a 1.4% COLA. I'm going to get off my soapbox, but I'll let you react to that.
No, that's exactly the point, Jeff. Unfortunately, COLAs do not do a good enough job of helping seniors retain their buying power. And I think unfortunately, it's a big misconception that you can live on Social Security alone. You can't. For the average earner, those benefits right now will replace about 40% of wages. But when you think about it, right? So let's say you earn $100,000 a year. So you want to assume that Social Security will pay you, and 100 is not even actually an average wage. So this is going to be inflated. But let's just for some math simplicity purposes, let's say you earn 100,000 and you want to assume that Social Security will pay you $40,000 a year. I mean, think about it. Could you take that kind of pay cut now? Could you live on that? People have this view of retirement that their living expenses are magically going to go down. But the reality is the only thing you're really likely to save a lot of money on is commuting, because conceivably if you're not going to a job, you're not, I guess, driving or incurring that expense as much. Now, maybe your mortgage is paid off, so that's another point of savings, which is why you don't need necessarily 100% of your working year wage once you retire, but you probably need a lot more than 40%, especially because your healthcare costs are going to rise. So the rule of thumb I like to go by is assume you'll need like roughly 75-80% of your former wage. You'll need more than that if you intend to live a more high-end lifestyle, if you tend to travel a lot, do things that cost money. If you're planning to live a frugal lifestyle, maybe relocate somewhere where the cost of living is cheap, you might get by on 60% of your former wage. But for the most part, do not even if Social Security cuts do not come to be, and that's a whole separate discussion. But even if that doesn't happen, Social Security only pays the average senior today a little bit over $1,500 a month. That's a little over $18,000 a year. Most of us can't live on that. I mean, granted, I've got, a household of 5, but even if it were just me alone, I could not live on $18,000.
Yeah.
So, I think people just have to, unfortunately, just wake up to the fact that Social Security is not this, miraculous program that kicks in and allows you to live a comfortable lifestyle. You need savings of your own. You need to specifically read up on health care, because that's probably going to be your biggest expense once you turn, once you hit your mid-60s or, hit retirement.
Yeah, well, a lot there for people to unpack, whether you're on Social Security, not on Social Security, whether you're not retired or not retired. Mari, always a pleasure chatting with you, and appreciate you making time out of your busy schedule for us, and enjoy the rest of your weekend, and we'll talk to you again soon.
Okay, thanks, Jeff. You too.
Bye-bye. Welcome back. Now time to talk a little tech. And joining us on the line, he's a lead advisor and executive producer, for Seven Investing, Mr. Dan Klein. Dan, welcome back to the program. Great to have you this morning.
Oh, thanks for having me, Jeff.
So, Dan, I know we want to get into tech earnings and some of them disappointing, but this is an interesting story. Are TVs maybe watching us? I'm curious about this, Dan.
Yeah, so we've talked about this before, Jeff, but like when like you and your wife on the couch have a discussion about like, I don't know, like, hey, should we get dinner at the Cheesecake Factory tonight? And then like the next day you open up your web browser and like all your Facebook ads are for the Cheesecake Factory. And it turns out that, yeah, your television is watching you if you have a smart TV. And it's possible to disable it, but it's not necessarily something most people have done. So it is selling your data to marketing companies. You know, it's not like crawling into your room while you sleep or watching you in the shower, but it is watching you and learning from what you say while you're watching TV and the actions you take.
That's a little creepy, Dan. I mean, what if, I don't know how I feel about that if it's listening. I mean, I guess this goes back to the Alexa, whatever the Apple version of that is, kind of theme that we talked about maybe over a year ago, where it's kind of same kind of thing happening. You know, what happens to all the things that you say to Alexa or say to Siri? Where does that all go? Apparently goes in some database.
Yeah, I have really mixed feelings about it because I'd be okay with it if I got better results. So if it was really good at parsing out what I actually want to know versus what it thinks I want to know, I'd be fine with that. Because like the example I'll give is my wife and I bought new couches. So for weeks, all we looked for on the internet was couches. We were going to all the furniture stores. We were looking at all the online places. And then at some point, we bought couches. And Jeff, you know what you don't need to buy after you just bought new couches for a really long time?
Another
Couches.
couch. Yeah, another couch. But you're probably getting solicitations for couches.
For months. So there should be a better way to manage it. It should be easier. Like one of the examples is Netflix tracks your data. Now, Netflix uses that to serve you better recommendations, but let's say you don't want that. You can go into your Netflix account and turn that off, but I'd feel better if companies, when you registered, were more upfront about letting you set privacy settings and what you want to share and what you're willing to let it use to give you better information, what you're willing to use to let it to give you better ads. Look, if Facebook gave me great ads for what I was actually looking for, that would be a service, but that's not really what happens right now.
Well, Dan, I mean, that's all in your EULA, right? Your end user licensing agreement, or whatever they call that document that you get along with your receipt and your box. I mean, you're supposed to read the 80,000 pages in very small text. And look, I know you just had LASIK surgery done, so you should be able to read that very clearly.
Yeah, and Jeff, I'm doing that, but I'm a little far behind, so I'm still reading the EULA from my Apple Newton. I'm about 30 years away from getting to the. No, look, nobody reads these things, and there should be more transparency. We should know where our data is going. And look, I'm fine in most cases with my data going to make my experience better or on an aggregate basis to be used. I don't necessarily want the fact that I search for something today to make the rest of my ads that. Like, it should be easier to say, hey, sorry, I already bought a couch, I don't need another one, or yeah, I just got the new iPhone, I'm probably not going to buy the new Samsung phone. Like, and we've brought this up before. You know, I use an Amazon Kindle, though frankly I don't use it that much anymore. I mostly read on my phone, and I have the Kindle that gives you ads. Amazon knows every book I've read in the last like 7 years, and they've never once served me an ad for a book I wanted to buy. That to me is just a faulty bot. Like, you know that I read like book 2 of a series. How about tell me book 3 came out in an ad? Like, it doesn't make any sense how this data is being used. And I feel like there's actually going to be a big advantage in companies that do it better over time.
Well, again, this comes down to we unfortunately don't have enough time to devote to how many different permutations of this it is, but I would just say, Dan, that I think you bring up a really good point in terms of privacy. You know, that fine line between privacy and user experience. And look, you have a device. You should be able to be told. You should be told, I think, when your data is being used. And just for the record, we don't use any data here on the Broadcast Retirement Network. People may view articles, they may view shows. None of that is being mined. None of it is being sold. So point of clarity there. Dan, I want to switch gears because we got some earnings numbers. I know you want to talk Apple earnings, but some of the tech company earnings, not as good as I would have expected, given the shift to tech that we talked about on the network this week, during this pandemic.
Jeff, I think we're in a screwy market, and I haven't
You
dug
think?
into.
You think,
Well,
Dan?
here's the thing. Let's talk about Apple a little bit. Apple posted what I would consider stellar numbers. Their earnings came in over estimates. Their revenue was up 1% year over year. iPhone revenue was down 20.7%. But the new iPhone comes out. It's almost out, or it's like sort of out. You can order some models and not others.
Hmm.
Services revenue was up 16.3%. Other products, that's like headphones and smartwatches, is up 20.9%. Mac revenue up 28%. iPad revenue up 46%. And their gross margin was up a tiny little bit. What do you have to do for the street to say, hey, their shares are down about 5%? That makes no sense. Why? Of course, iPhone revenue was down 20%. Who buys the old iPhone after they've already announced the new iPhone? I think right now, Jeff, you have to remember as an investor, buy good companies and hold them a long time. If you like Apple, this is an opportunity to buy Apple at a discount. I didn't follow Google, Facebook, or any of the other earnings. We're talking about that on my show, taping later today, which will be before this airs. And that said, I wouldn't be surprised if all the numbers were great for Google, Facebook, Amazon, whoever else reported, and that the shares are still down. It is a wacky, wacky market where people are looking for bad news. And then in some cases, companies report and the news isn't that great and people like it. So don't make short-term moves.
Well, I think that's the key takeaway, Dan. And I think if you're following the market, look, we talked about this today. We're recording this on Friday with Devon Banerjee and a little bit about Robinhood, and you and I have talked about that as well. And I think there's some real lessons. It has me in a. I love the technology aspect of these things in terms of investing and getting access, and more people have access. We talked about the unbanked and giving those people access. That's all great. But the other flip coin of this is that people, I always say the downside. Last thing I'll say is the downside of daily valuations of 401k plans is that you can trade daily. I liked it back when I got into the business. It was quarterly valued, meaning you couldn't trade on a daily basis. You could at minimum trade quarterly. Well, you see what happens when people try to trade the market. You're not going to be able to time it. That's a real problem. But
Yeah, people
ahead,
also
Dan.
don't understand the market. So let's go back to Apple for a second here. Apple had a problem a few years ago that in some quarters, the iPhone was about 70% of their revenue. You don't want any one product to be 70% of your revenue. So they diversified. They went heavily into services. They tried to get more people to buy Macs and iPads and headphones and watches. Well, that's working. So the iPhone is no longer the sole driver for Apple. It probably came in under 40% for this quarter. I don't have those breakdowns yet. That's not going to be true next quarter. It'll probably be 50 or 60%. But when you're diversifying your revenue and those numbers are climbing in an off-cycle time for your product, that's really, really good news. But your day traders don't understand that. Your day traders saw, oh my God, iPhone revenue down 20%, and they're not smart enough to go, well, why was that? Oh yeah, the new one comes out. Oh, I'm going to wait a week and buy the new one. I'm not going to buy the old one. It's really day trading is a way to lose money. You cannot time the market, especially now when the market does not behave in any way logically.
Well, I think you make up some really good points. And look, I think things are going to be screwy for some time in terms of the volatility. That's at least what, you take it with a grain of salt. Dan, always a pleasure chatting with you. And I love that we're going to talk again on the network on Tuesday. So we'll chat with you then.
Jeff, I'll see you Tuesday.
Welcome back. Now time to talk a little markets and a little cryptocurrency. And who better to do that than Kevin Kelly? He's co-founder of Delphi Digital. Kevin, welcome back to the program. Great to talk to you this morning.
Thanks for having me, Jeff.
Okay, so less than a week away from a U.S. election, big election. Not sure if you knew that was happening, but
I heard that was next week.
yeah, there's a rumor painted on the wall. But in all seriousness, lots going on with the market this week. So before we get to crypto, give us your assessment of market events this week.
Yeah, so you've certainly seen volatility come back across, asset classes more generally. You had equity volatility kind of blow out a bit this week. Some of that is in part because, we've been talking about tech has certainly led the way in this recovery, and I think valuations have certainly gotten a bit stretched. And then you had some disappointing numbers from some of the big kind of tech firms over the last 24 to 48 hours. Part of this is also, obviously people kind of gearing up for next week, as you mentioned. I do think, volatility, if you look at just kind of the curve and volatility, looking at the futures curve, there's not, I think volatility will kind of be suppressed after we get through this, right? So it might end up being a rather non-event, but I think what's really difficult to try and figure out is what the aftermath is going to look like immediately, because as we've heard time and again, we're most likely not going to find out who the next president-elect is, and if it's Trump or if it's Biden, on actually election day. And it could take, up to a couple of weeks or even longer, hypothetically, for us to actually, have a confidence in declaring a winner, right? And so obviously, as we've talked about time and again, markets hate uncertainty, and that is, uncertainty kind of at its largest form.
Kevin, what do we make from a lack of fiscal stimulus? That's something that the market has depended on, seems to have bolstered numbers. We now go into this election period, and probably after, because we don't know, lawmakers are going to be focused on, did I win, did I didn't win, but fiscal stimulus, no plan in place. What do you make of that and the impact it might have on the markets?
It's quite unfortunate, to be totally honest with you. I mean, we've talked about how there's a large cohort of the country that is still really struggling, from your small and medium-sized businesses to, your average American, your average employee out there. And so I just think, as we've said, the longer and longer this goes on, the longer and longer we go without some type of fiscal stimulus, the larger the consequences are going to be on the back end of this, because we simply, especially in certain pockets of the private sector, there is just too much debt and too much leverage, and that's also been exacerbated by companies going out and getting loans, or even people kind of deferring rent payments and things like that throughout this pandemic. And eventually, lenders are going to come knocking, and a lot of these loans won't be forgiven, at least from our standpoint. So again, it's only kind of a matter of time in which I think the public sector will be faced with a really difficult choice, which is, do we really ramp up even more fiscal spending and essentially monetize that through the central bank and through quantitative easing, or do we kind of let the business cycle and the market kind of free ride and take its own, see what happens in the free market itself? And I don't think, just based on what we've seen, especially in the last decade or so, I find it very hard to believe that policymakers are just going to sit on their hands and sit on the sidelines. So, what we warned about in terms of not giving, enough fiscal stimulus when the time was appropriate, and when you started to see some of these benefits run out, now that we've gone, 2 months plus without it,
yep.
It definitely shows signs for concern, because eventually now, the reactionary function of this is just going to be much greater and much broader.
Kevin, let's switch gears to cryptocurrency. That's in the news as well. What can you tell us what's happening from the crypto and blockchain front?
Yeah, so surprisingly, I've mentioned how historically Bitcoin, the crypto market, I'll focus on Bitcoin right now because it's definitely, jump back into the limelight. I've talked about how Bitcoin tends to have an inverse relationship with equity market volatility, right? Which makes a lot of sense. Any type of asset class, especially what we saw in March when you see liquidity really dry up. Bitcoin and crypto certainly were not isolated from that. What's really interesting, and I think, I put a note earlier this week to some of our clients, basically saying that, I don't want to say this time is different, but I certainly am getting different feelings from the latest kind of rally in Bitcoin. Back above 3,000 is trading right around, 13,000, trading right around 13,400 as we're talking right now. I think this is a bit of a paradigm shift, because historically, again, you've had that inverse correlation with the VIX, and the VIX blew out this week, and Bitcoin, to be honest, barely even flinched. And I think that is a really, really critical test, especially for traditional investors who are looking at, across different asset classes and saying, okay, from an asset allocation standpoint, can we make the argument for Bitcoin being a diversified investable asset? And what it's done, at least in the last few weeks, really kind of arguably being the asset that's held up the best in the face of the equity market sell-off this week and the rising market volatility environment. I think, if Bitcoin can kind of hold on to these gains and continue to be be resilient, I do think it could actually go really far in terms of putting it into that really kind of, again, true diversifiable, investable asset in terms of the mindset when it comes to how people, and especially traditional investors, are looking, at this asset class.
Kevin, what about you mentioned Bitcoin, but there's lots of different brands, Ethereum, Ripple, others. How have they performed? Are they still have they seen a run up? Because I think people need to understand these are not fiat currencies like the dollar, and so there's like I don't know how many different cryptos there are, but there are quite a few. How have the others performed relative to Bitcoin? Now, Bitcoin gets all the press, so to speak, a lot of times, but how have these others done?
Yeah, so we had the what we like to call the summer of DeFi craze, and DeFi stands for decentralized finance. And so there were a lot of really interesting, innovative projects that came to market earlier this summer. And so you had this pretty big run up in that subsector of crypto, right, with some of these DeFi tokens. We've seen a really big retracement since then. Some of these are down 40, 50%, a handful are down, 60, 70%. So we've certainly seen a sizable pullback. The rest of the crypto market has experienced, I would say, similar price action, aside from a handful of select crypto assets, part of which, and this is like your Bitcoin Cashes, your Litecoins, Bitcoin, obviously, that PayPal came out last week, I believe it was, and announced that they are supporting select crypto assets to be able to be used, that their users can buy, sell, and trade those cryptos, but also their 26 million merchants are able to accept those as forms of payment. So those that were actually named from PayPal that they're supporting initially have actually held up relatively well, which is not that crazy to believe, just because again that potentially is a huge market for new users and new adoption. But aside from that, I mean, in general, the crypto market ex BTC, or the crypto market outside of Bitcoin, certainly has, I think, taken a backseat to, the king at this point, just because of kind of the global macro environment. And now that you're starting to see more, not only, prominent fund managers and global macro folks, but also corporate treasurers come out and start to add to their positions and take new positions in Bitcoin on their balance sheet. I just think, again, the kind of landscape underneath our feet is certainly shifting. And I think the foundation that Bitcoin's been built upon is only strengthening by the day. And you're just seeing that confirmed through a lot of the recent headlines around it.
Well, it is certainly going to be an interesting next 3 or 4 or 5 days. Going to be interesting to watch the markets and also what happens with cryptocurrency. Kevin, pleasure talking with you as always. Enjoy the rest of your weekend, and we'll talk to you again next week.
Thanks, Jeff. Looking forward to it.
Bye-bye. Welcome back. Now time to check in on the latest social media trends. Joining us online, he's Senior Financial Services Editor for LinkedIn, also the editor of the This Week in Finance newsletter, Devon Banerjee. Devon, thanks so much for joining us on the program this morning.
Absolutely, Jeff. Always good to chat.
Yeah, and look, we get to chat with you twice a week, generally speaking, and lots going on. Everything changes minute to minute, day to day, I would imagine, on the platform. What's top of mind for you this week and the team at LinkedIn?
Another very busy week on the platform, Jeff. I have a feeling I say that every week. But
that's good. It's a good thing, though.
It is a good thing. We're just chock full of news and views and insights on the platform. You can find most of it at the top right of your LinkedIn feed in the module called LinkedIn News. So I'm going to hit a couple different items this week, Jeff. As you know, every couple of weeks I do take a deep dive into what's trending in the healthcare area on the platform. I'm going to bring 2 healthcare stories to you to begin. The first is a study that we featured from the New England Journal of Medicine. Now, look, it's quite well documented that unfortunately female doctors on average do earn less than their male counterparts. We've seen so many studies on this. In 2016, researchers found the median salary for male physicians in the United States was about $86,000 more per year than that for female physicians. Earlier this year, a study found that in their first year after training, so early in their career, male physicians already earn about $36,000 more on average. So again, unfortunately, well documented. But what the New England Journal of Medicine looked at is some factors as to why this may be the case. And one thing they found is that actually, on average, female primary care physicians spend more time with patients than their male counterparts, about 15% more time on average with each patient. And if you think about that, as a result, they end up seeing fewer patients over the course of a year. And the way insurance operates in this country, insurance companies pay doctors generally based on the number of patients they see. And so that is actually a huge driving factor in why this overall number on average is lower for female physicians. Now, the story we featured was actually some NPR reporting on this study. And this NPR reporting was actually done by a female physician who's a contributor to NPR. And she had some interesting insights from herself and some of her peers, women physicians, saying that, look, of course they think changes need to be made and that pay needs to be more equitable, but she would not change the amount of time that she spends with her patients. She thinks that makes her a better doctor. It makes her understand her patients better and in a more holistic fashion. I mean, look, all of us have been to doctors or medical appointments where it's quick in and out. There's small talk and pleasantries with your healthcare provider, and there's no real relationship struck up there if you think about it. And she says she does not regret spending, 2.4 more minutes chatting with her patients about their lives and their worries and their concerns. So a tension inherent here, just again, as I said, the way the insurance system operates in this country, but something interesting to keep an eye on.
Yeah, look, I think I like a bedside manner. As a metaphor. I mean, I think that it's important to build a relationship, whether it's you're a doctor or some other provider of services to somebody, till you get, you get to know them more, and especially when it comes to people's health, we're all individuals. Seems to make sense. I just can't. I guess I need to understand more about how that equates to why that would mean a difference in people's compensation. I get it that you're seeing fewer patients per year overall, but it doesn't seem like that much of a variance, Devon. But who am I?
Yeah. No, absolutely. It's those, again, unfortunate tensions inherent in insurance reimbursements equates revenue for the hospital, and so when you're kind of putting side by side, unfortunately, these physicians, some of them are bringing in quote unquote less revenue. So again, an unfortunate inherent tension, I think, but I'm glad this study came out and more people are talking about it in the healthcare system.
Yeah, it's certainly a volume business now. I'm not sure if that's a good thing. I like to have a relationship with my doctor so that he or she knows more about me, so they can make the best decisions possible on my behalf. And I'm only wondering, Devon, as we continue down this telemedicine road, which obviously gained a lot of popularity in the pandemic, are we going to see just doctors seeing even more patients on this rotisserie and making decisions, which will increase, I guess, their earnings, but maybe diminish bedside, the bedside manner that some of us are craving.
Yeah, absolutely. And since you mentioned telehealth, Jeff, I'm going to skip ahead a couple stories to the latest takeaways from our Workforce Confidence Index. As listeners who listen to this segment know, every couple of weeks at LinkedIn, we survey thousands of our LinkedIn members for a pulse on how they're feeling about their job security, their career outlook, their personal finances. So we took a look at how confidence has trended since April. Over the past 6 months. And overall, we're pleased to report that confidence among U.S. professionals overall has ticked up a couple points in that period. But diving into a couple industries, manufacturing has seen a large increase, but another industry that has seen one of the largest increases was healthcare. And my colleague George Anders did some reporting on this, speaking to a lot of folks in the healthcare industry. And he found a couple things. One, to stay on that point of telehealth, that people have really adapted to that. There was a period where some people resisted it. There was a period where, as you and I have talked about, people might not have had internet connectivity or devices to to leverage for telehealth. But those, given it's been 6-7 months, a lot of people have figured that out. Safety protocols have also been figured out for in-person healthcare. Some of those concerns have been figured out. PPE, personal protective equipment for healthcare providers, has been sorted by now. So that was a healthy sign in the index. At the bottom, in terms of those industries that have seen declining confidence, unfortunately, recreation and travel continues to decline. There was a blip upward I discussed with you about 2 months ago when more of the country was opening up, but that is reversing the trend. Energy and mining is also declining as well, and construction is now declining. So not great, not surprising either, but that's just an update there. I also did a deep dive, transitioning a bit into my financial services beat. We did a deep dive into unemployed job seekers in financial services, and what strategies they're considering to find their next opportunity. I found this kind of interesting. We gave them 5 different strategies and had them check the boxes on which strategies they're considering. Mm-hmm. The most popular strategies for someone unemployed in finance right now are actually to freelance, which is to say to go it alone, become an independent consultant or an advisor. About 59% said they're considering that. And then 56%, a majority, said they would consider pivoting industries. They would consider leveraging the skills that they have built up over a career in finance and pivot into maybe fintech or technology or other industries. The least popular options are accepting less money. Only about a quarter of people said they would do that to find a job, and relocating geographically. Only 15% said that. So I started a really interesting conversation. There are now hundreds of comments, if you look under my profile, on what strategies these people are considering.
Well, I think we're all kind of in that boat, right? If you unfortunately lost your job or you're looking for something new or different, you've talked about reskilling over and over again, the importance of doing that. Now's the opportunity. If you've got skills that you've acquired over the last decade and a half, and it's always good to try to learn new things and try to see how they apply. And I got to tell you, I think the gig worker route, as we've talked, is really the future for so many people, because it gives you flexibility. Maybe gives you an opportunity to earn more income. And I think we're going to see a lot more people kind of go that route, even post-pandemic, post-market volatility.
Yeah. Absolutely. And that leads me very well into a final topic I'll mention, which was one of our most popular items this week, based on a Fast Company piece about the 6 skills that employees will really need in the post-pandemic workplace. I'll mention the 6 quickly. The first is self-direction. So much change is going on. Employees are going to need to take ownership of their roles and be even more highly self-directed than in the past. Number 2, really important, is just digital capabilities, a comfort with technology and collaboration and communication in how you're measured and your productivity is measured. A lot of employees have resisted being measured that way, but people are going to need to get used to that. Empathy, really important, just understanding that others, your colleagues, your managers, your reports, are going through things that you may not know about, you may not see in the little Zoom window. Communication management, related to one I mentioned, that's just important, whether it's digital or not digital. If you're not in the office, everyone needs to get more comfortable, communicating with, again, colleagues, managers, reports. Adaptability, of course, that's a no-brainer, but you're going to need to be comfortable changing the way you work. It's just a fact, and you can't resist it. And then finally, motivational skills, and that's motivating yourself, but also motivating others, persuading others. It's easier to do in person, but again, it's just a fact of life now that we're not in person as much. So you need to be able to both self-motivate and inspire others to see your vision, even if it's via the Zoom window.
Yeah, I think one that so flexibility, obviously one that stands out to me, but also self-motivation. I think we've learned to self-motivate ourselves and working remotely during this time. But it's interesting that a lot of those skills you ticked off for me, Devon, how I heard them were more qualitative and less quantitative. So there was some measurement in there, but like there are definitely things that are like the softer skills. You've talked about this before, like being able to apply some softer skills, empathy, and other things that you need to be a better worker and a better manager, and better leader. I think those are things that those are nice to hear from at least my point of view.
Yeah, that's a fantastic point, Jeff. The hard skills for any given job are just table stakes now. That's how you get in the door. That's how your application gets through the recruiter and into the hands of the hiring manager. And then it's the soft skills that makes you that help you stand out.
Absolutely. Well, Devon, we're going to leave it there. Thank you again for doing double duty this week. We always appreciate you having you on the network, and then you always make time out of your busy day, which is exceptionally busy and starts early and goes late, I might add, to come on the podcast too. Have a great rest of the weekend, and we'll talk to you again next week.
Sounds good, Jeff. Take care.
Bye-bye. Welcome back. Now we're going to talk about some of the investment themes of the week, or markets themes of the week. We've talked markets and crypto with Kevin Kelly, but now we're going to welcome in Oliver Renick. He is the lead anchor on the TD Ameritrade Network. You can find him on bookending programming on a day-to-day basis, Morning Trade Live and Markets on the Close. Oliver, welcome back to the program. Great to talk to you again.
Hey, Jeff. Thanks for having me. Appreciate it. Fun week to talk about.
Yeah, well, fun week as long as you're not riding that roller coaster, I guess. But look, what you do bookend coverage. You're the first show in the morning, and you're the last show, or one of the last shows in the afternoon, following the close of trading. What are some of the key takeaways, key themes that you can articulate during the week?
Well, this week we had more selling, and it was pretty broad-based. We are going to end up with every sector in the red on the week. The market's going to be down about 6%, which is a very big move, even sort of by COVID standards. That's so far behind us now because it's been just such a steady up market. This will be the worst week for the S&P going back to the COVID sell-off of March 20th, which was a 14% decline. So the perspective here is that investors are getting a little bit kind of stuck because there's just not a lot that's working. And part of the problem here is that there's very few asset classes hanging on. And I'll start by giving a shout out to Bitcoin. As viewers or listeners of your podcast may know, or viewers of mine know, that I've generally been a skeptic, and one might go as far to say a cynic. I would just say a very kind of fair observer of events for Bitcoin, but it's never really been compelling to me as we started covering this in 2017, just because there's a lot of very unique things that have to come to fruition to make Bitcoin a compelling story, in my opinion. But this week is actually probably one of the most compelling moves for Bitcoin that it's had since I've really even known about the cryptocurrency. So it's really one of the few things that's actually working on the week. Now, in the past, that has kind of been a heartbreaker, especially when you're at big levels like Bitcoin is right now compared to the 2019 highs. So TBD on that, but would just start by saying that on a week where everything's down from gold to bonds to stocks, Bitcoin does look quite compelling. If it can hold this performance as stocks continue to drop, that would be really impressive, and would make a believer of me, at least as a first step. So that being said, most people don't hold Bitcoin, though. So no matter what you're in this week, you're down. Mm-hmm. And the problem is that if you're in tech, you're down actually more than the market. Not the worst performing group, but you're down more than the market itself. And that's really important, because what this means is that people are not buying dips with the same ferocity as they have been throughout the recovery. There's a few reasons for that. Some are more complex than others, but kind of the simplest way that I've been describing it now for 2 months, as our coverage started turning more bearish, really just kind of luckily enough, the first week of September. The point that I've been trying to drive home is that the scenario of the last 6 months is so uniquely positive and bullish for technology stocks. Mm-hmm. It's very difficult to picture a future in which those companies deserve as high of a valuation as they've gotten. And here's why. Investors pay up for companies that are growing the most. They pay the most for growing companies when the economy is at its worst. The slower the economy gets, the more they're going to be willing to pay for a stock that's growing. So what we just went through was this very unique period where the economy was collapsing, but because we were all inside consuming and we got checks from the government, the growth of technology companies was actually accelerating. So the spread, if you envision the economy's growth going down and tech growth going up, that spread is very, very hard to keep going. And it means that people are going to pay as much as they did, the highest valuation since .com for tech. But as the economy slowly gets back to normal, then growth in the economy comes back. We saw GDP surprise to the upside this week. So our economic data is still doing good, despite the fact that we haven't had a second round of stimulus.
Yeah.
So as the economy gets better, that chips away at the reasons for owning technology stocks. And then because bonds are selling off, even though the market's selling off, you have yields climbing on bonds, which also chips away at the case for owning expensive companies as interest rates rise. So it's a very puzzling situation, and I've called it the trap market because the obvious catalysts for upside that people are looking for, resolution in the election and potentially more stimulus, those are not obvious catalysts based on this thesis for a higher stock market. Because even if we get stimulus, if it's a Band-Aid to improve and help the conditions of the beaten down industries, that's going to make those industries more compelling to investors to buy, not tech stocks. So right now, it's just really a trap where there's not an easy way out to think about why people would pay more for these tech companies than they did in September, unless there's a shock stimulus that drops a ton of money onto the market. Even a vaccine surely would increase sentiment and optimism, but it also would lead to investors buying up companies tied to a reopening economy, not a quarantine tech trade. And that's what matters to the level of the stock market, is what tech companies do. Until tech companies get small enough again to where they don't drive the direction of the market, this is going to be a trap market for a long time. That's the problem that we have right now.
Yeah, I was going to ask you, Oliver, and I'm not going to ask you to rehash it, but I was going to ask you about the election. You mentioned stimulus. We didn't get stimulus as many were hoping.
No.
I think the market was certainly hoping, and you seem to indicate that with your remarks. But if we figure out who the president is going to be after the 3rd, because we don't know for sure if it's going to be decided on the 3rd, right? We may not know until a day, a week, a month, or after. That could cause more uncertainty, but as it relates to stimulus and other decisions that were kind of put on hold, or changes that were put on hold.
If there is a surprise in the election, there might be some short-term volatility. If there's it's just hard to see how the election will really change much when, frankly, both candidates have said they want to spend money. Mm-hmm. One guy people have said they're a little bit more willing to spend some of that money, but at the same time, they're willing to spend money in different areas, perhaps. So it just, again, comes to a stock and a sector story post-election more than it does the market overall. So if investors are waiting on the election to bring some great catalysts to undo the themes that I'm talking about here, it doesn't seem obvious in my eyes, which still leaves us in a little bit of a problem for bulls.
Well, I think, Oliver, it's going to be a wait and see. It was a wait and see on COVID and the vaccine and the pandemic and the impact, and we've all been living day to day, minute to minute, kind of waiting to hear on what's going to happen. And it sounds like that's going to be the case when it comes to the election, and ultimately we're going to see how the market reacts. We're going to leave it there. Oliver, really want to thank you for stopping by the show. Really appreciate your analysis. And
hope I didn't scare anyone.
No, you didn't. Well, it is Halloween, or it was Halloween. By the time this airs, it will have been Halloween. So it kind of fits right in. But I think it's an even assessment of what's happening, just my opinion. Thanks a lot, and we look forward to having you back on the program again next week.
Thanks, Jeff.
Bye-bye. Welcome back. Now time to talk real estate and a lot more. Joining us on the line, Market Watch's Jacob Passy. Jacob, thanks so much for joining us on the program this morning.
Happy to be here.
And you get to do double duty. You and Devon Banerjee this week do double duty both on the network and on the podcast as well. So what's top of mind this week when it comes to real estate, when it comes to travel?
Yeah, so on the real estate front, I worked on an interesting story. So I am writing a new column for MarketWatch called The Big Move, where I answer readers' questions about the real estate process, how to buy, how to sell, etc. So I got an email from a reader this week asking about his situation. So he has, believe it or not, nearly $600,000 in student debt.
Oh, my Lord.
He's gotten 4 degrees and is working on his 5th, his doctorate, but he wants to buy a house and, was basically asking, how can I go about that right now? And in reporting this story, I kind of uncovered an awkward situation that a lot of folks might be in right now if they're trying to buy a home but have student debt. So as listeners may know, a lot of federal student loans, not all, but a lot of federal student loans were automatically put into forbearance as part of the CARES Act. And then in August, President Trump extended the length of that forbearance to last until at least the end of the year. It could theoretically be extended again, but as of now, those loans are in forbearance until the end of the year. So what that means is folks aren't making their monthly payments and aren't required to. And this was done because a lot of, recent college grads and whatnot are, facing a really tough job market right now. And so this was kind of a way that the federal government was able to reduce their burden. But it creates some headaches when it comes to the mortgage application part of the process of buying a home. So, to qualify for a mortgage, lenders will look at your debt to income ratio. So they want to know basically how much debt you already have in relation to your monthly income so they can kind of figure out how much of a mortgage you could afford. And so when they're calculating that, they normally take a look at your credit report and see, what your monthly debt payments are and basically add those up to create your debt to income ratio. The problem right now is if you have a lot of federally held student loans, right now your credit report is showing 0. It's showing no monthly payments because you're in forbearance. Now, obviously, that doesn't mean that you're never going to repay that mortgage, but it creates an interesting situation. And so basically, mortgage lenders have to take different approaches to these loans right now to figure out borrowers' debt to income ratios.
Well, Jacob, I want to go back to $600,000, and I guess this is not a topic necessarily for real estate, but you said the gentleman has, I'm assuming it's a gentleman, the individual has 5 or 6 degrees. I'm trying to equate what that means in terms of compensation, and then, from a practical point of view, just the listeners out there thinking this and saying, okay, well, does that really make sense in the long term? I know your focus is really on real estate, but these are the types of really important decisions you make early on when you're kind of fleshing out where you're going to be in your career, where you're going to school, that could have a negative or some type of impact on you getting large purchases like a house, a car, etc.
Yeah, so I asked that kind of exact question to the mortgage lenders I spoke with when I was working on the column because I was like, that's a lot of money in student loans. But as one of the folks I spoke with said, well, it is and it isn't. Basically, his point was like, if we're people, it's not super uncommon for, say, a doctor to have hundreds of thousands of dollars in student debt when they're done with school because, medical school can last many years, 4 or 5 years. This person in my column, he's getting his doctorate in education, so he's not, a doctor per se. But nevertheless, if we were to say that that's an outrageous amount of money to have in student debt, then basically no doctor in the United States would be able to buy a home.
That's
obviously
true.
That's not the case. So, and it's important to, student debt is certainly a big deal. It certainly precludes a lot of people from being able to save to buy a home because, this individual, he's likely making large monthly payments towards his debt. And, that reduces the amount of money he has at the end of, the month to put away towards the down payment and things like that. So it certainly is a major barrier. But when it comes to the underwriting, lenders aren't looking at your total student debt usually. They're usually just looking at your monthly payment. So, in normal times, they don't care at all if you have $10,000 in student debt or $1 million in student debt. They just care about how much you're paying each month.
Yeah.
Now, I think, if we're asking, is it advantageous or not to accrue that much student debt? I think that is a relevant question. I think that, anyone should stop to reconsider before racking up hundreds of thousands of dollars in debt, especially oftentimes this is happening at a young age, because it does definitely, have an impact down the road. But, with my column, one of my big points was like, having debt doesn't inherently preclude you from buying a home. But right now, having $600,000 in debt can make things more difficult, which I got into in the column. And that's in part because lenders have to use these different strategies of getting at your debt to income ratio than they normally would. So for instance, right now, Fannie Mae is requiring if you can't report an actual payment from your credit report for, your monthly student loan payments, then what they are requiring lenders to do is to take basically 1% of the total balance of student loans and use that in lieu of what the monthly payment would be. So in this individual's case, he's going to, the lenders are basically going to have, if it's a Fannie Mae loan, they're going to say that he pays $6,000 a month towards his student debt, even though that's probably not what he was doing before, the pandemic began. Freddie Mac does it a little bit differently. They say, 0.5%, so that would be $3,000 in this case. FHA does it even differently. They give a range of options, either 1% or, they allow you to, find the actual documents and payment from before the forbearance period and use that. But, lenders have to choose, and, FHA can be stingy. So oftentimes lenders will just go with the 1% figure. And they're supposed to report whatever figure is larger. So if your actual payment is smaller than the 1% figure, then they would report the 1% figure. So there are different ways of going about it. And then, when we talk about student debt, we also get into, repayment plans. So lots of folks, who have high student debt burdens can request from their student loan servicer an income-based repayment plan. If you're making, a small salary, obviously, $600,000 in debt is going to be hard to pay off. So you can ask for a repayment plan that takes into account your income. And in some cases, those plans will be structured in such a way that after a certain number of years, your monthly payments will grow as your income grows. Or, if you're working in a public sector type of situation like this individual likely is since he's an educator, you can sometimes request student loan forgiveness. There are certain programs out there where if you serve in a public capacity working for the government or other public agencies or nonprofits, you can get your student loans forgiven after a certain number of years of service in those roles, and then you don't owe any money. So there are certainly options out there to reduce your burden, but it is a difficult situation for folks right now because, normally, this individual, he might only pay, a couple $1,000s a month towards his student loans, which is still a lot of money, don't get me wrong, but it's certainly much less than $6,000. And so it definitely complicates matters when it comes to qualifying for a mortgage, but doesn't preclude it entirely.
Yeah, really interesting. And you're right. You make a really good point that it's not having debt isn't a bad thing. It's how you manage the debt and how much of that it is of your total portfolio and what type of debt it is. Well, Jacob, we're going to have to leave it there. Really appreciate you, as always, coming on the program. And, of course, this week doing double duty. Have a great week, and we'll look forward to having you back on next week.
Yeah, soon.
Bye-bye. Welcome back, and now time to catch up on what's happening with retirement. Joining me on the line is MarketWatch's retirement reporter, Alessandra Melito. Allie, welcome back to the program. Great to have you this morning.
Yeah, nice to be back.
Yeah, it's great to have you, and we always rely on you and the MarketWatch team to kind of fill us in on what is the biggest news in the week on retirement. So what can you tell us? I know there's a lot going on. We've got a new bill in Congress. We've got COLA adjustments or new IRS limits for 401 401k and IRA plans, but what piqued your interest this week?
So honestly, there was a lot going on. That retirement legislation that you mentioned is probably the biggest thing since the Secure Act happened last year rather, not last week.
Feels like last week.
I know. So we had that, like you mentioned, COLA. So something that has been on my mind lately has to do with Social Security, of course, because, I love to talk about Social Security. So we have a very big event coming up in less than a week with the election. So I had spoken to a few people just about what the outcome would mean for Social Security, and we took a little look at the two candidates' proposals, or what they've said about Social Security and what that means for retirees at the end of the day. So that's something that I thought, and I'm passionate about, just because those political outcomes will have some sort of an impact on the program, and so many people rely on it for some, if not all, of their retirement income, and and all that. So there were very distinct differences in the candidates and their approaches to Social Security. President Trump, for example, doesn't have anything laid out completely, like written, all these different thoughts on that. But he has mentioned, cutting the payroll tax, and if that happens, that's a major source of income for Social Security. So that would have some obvious impacts on the program, even if they do end up using some sort of general funds for it rather. And the Democratic presidential candidate, Joe Biden, he has said he has a written proposal on Social Security, and it mentions things like making sure that there's a minimum for retirees so that they're not hitting the poverty line, and increasing the cap on earnings so that more people are paying into it for longer, and things like that. So it's very interesting to see like the different approaches to Social Security, but it is also something that isn't talked about very often. Like, we don't really mention it in the debates. They did touch on it in the final debate, but only to say that neither of them know what they're talking about with Social Security. So it wasn't anything about like the proposals themselves or what they hope to see come out of it. But of course, it's always top of mind for me, because it would, whatever happens, it'll seriously impact retirees.
Well, yeah, this is a big look. I mean, anytime it's called the third rail for a reason, right? And anytime someone tries to propose or change something with Social Security, there's a block of people that come out and they're either for or against, and they can sway the vote. So I certainly understand why both candidates probably wouldn't completely articulate their vision, or maybe a portion of their vision. Is it your sense, Allie, though, if and when this election is decided, because we don't know if it's going to be November 3rd, or if it's going to be a week thereafter, or some period of time, but will there be legislation or new regulation around Social Security? Or is this one of these things that, look, both candidates are out there running, they have to inform the different vote blocks, what the potential opportunities are, and then you kind of have to see where things fall, after the election in terms of the legislative priorities?
Honestly, I don't know. So Congress has made some strides as far as talking about retirement more, but not so much about Social Security. I know President Trump has said if he were reelected, he would move to cut the payroll tax, but he can't personally do that himself. That's something that Congress has to decide on. So I haven't seen much as far as like a lot of movement or discussion on Social Security, but they are thinking about retirement security, because they came out with that proposal in the House Ways and Means Committee that is like the second Secure Act, or Secure Act 2.0, they said. So, I am hopeful that that's something that, as they're thinking of retirement security, they consider the fact that Social Security is a huge source of security for a lot of people, and maybe make some great strides for that next year, or hopefully soon, because if not, the program is facing insolvency in the next 15 years. So
hopefully soon.
Yeah, and we're going to talk to the legal eagles right after your segment. But we saw, and you mentioned it, and I mentioned it as well during while you were talking. Is Chairman Neal released a bill to try to strengthen retirement security, and the reason why I bring that up is because that's really focused on 401k, 403b, 457, employer retirement plans and maybe some IRAs. But there are a whole slate of people in this country that really do rely on Social Security as their primary retirement benefit. So it stands to reason that something would need to be done to strengthen that program over a longer period of time. Because as you've told us, or at least recounted from some of the reports that we've talked about during your segment, that this is a benefit that really needs to be strengthened because it's paid out more than it is gotten in.
Yeah, and truthfully, I mean, a lot of Americans don't have access to a 401k, or even if they do, they can't afford to put that much away. A lot of people don't max out their 401ks, or they don't have IRAs, or there are so many people in this country who just don't have the means to save enough for retirement, or just aren't thinking about it until it's too late, and therefore they've lost time on their side for investment purposes. So Social Security does end up being a big deal, and whoever, whatever the perspective is on where it should be, how it should be paid out, all of that. At the end of the day, it is still a fixture for retirees, and it just, I'm hopeful that people will be talking about it more in the coming years.
Well, we need that because it can't just be policy for employer-based plans. I know we've got PEPs, we've got MEPs, we've got state-run systems that are trying to address it, but there's got to be, in my opinion, not putting this on you, there's got to be a very uniform approach. Meaning I'm not speaking for you. I just want to make sure the audience understands that there should be a uniform approach so that every American has the opportunity in some way, shape, or form to save however much they can save. And it includes strengthening existing programs to make sure that the benefits promised are delivered to people. Because if not, you're going to have a lot of unhappy people, I think, as we've talked about in previous episodes of the show. Well, Allie, we're going to leave it there. Really appreciate you coming on the program and giving us insight into retirement. We know you're passionate about it. We're passionate too, and look forward to having you back on the program again next week.
Great. Thanks so much.
Bye, Al. Take care.
Bye.
And that wraps up this episode of BRN Sunday. Don't forget, we're back again tomorrow for BRN AM. I'm going to be joined by UBS Financial Services' Marielle Schurig. We're going to be talking about women and financial security and follow up to our interview with Cindy Hounsell. So until then, I'm Jeff Snyder. Stay safe, keep on saving, and don't forget, roll with the changes.